and take notes. I'm tired of seeing so many different traders, lose and blow their accounts because they don't understand how the markets work and what drives the markets. So I'm going to show you exactly what's going on behind the highs and lows of the market. So that way you can see it from a different lens because so many different retail traders are thinking just their RSI levels are going to make them money. But what's going on is that they have no idea that it's not the retail traders that move the market. It's the bigger institutions, it's the hedge funds, and the banks. And this is how they think, and this is how they trap you. So if you take a couple of minutes to understand what I'm about to show you, then you'll know exactly how to trade and to stop being part of the trap forever. So to understand market maker and understand why it drives the market, you have to understand who the biggest participants are in the market. You may think that, you know, traders, everyday traders is what's moving the markets, and the way everyday traders think is how you win in the markets. But that's completely false. And if you look here, it says the top 10 currency traders in overall percentage value. You notice a trend. All of them, for the most part, are banks, are the biggest banks around the world. These are the biggest traders, whether they're doing it to service clients, to put commercial deals, or to actually invest in different currencies over the other. These are the biggest participants. So to understand market maker, you have to understand that the way that you're thinking about how the market works does not constitute how the markets are actually moving. So now that you understand that, let me show you how it works. So most traders, they look at the markets and they look at what's called support and resistance. So if I was to add some text, you have this as the resistance for people who don't know that that's resistance. And then you have support here. That's how most traders look at the market. They'll look at the market through those terms, support and resistance. So we're going to buy at support levels and sell at resistance. Then, if they want to, because there's multiple support resistance, if they want to try to guess which support and resistance is what they trade, they'll use different things like, the RSI, stochastic, CCI, Bollinger Bands, to try to judge where in the market or which support resistance to trade. If they're momentum traders, they're looking for breaks of resistance, so breaks of levels, I'll just say it like that. And they'll look to trade the market down into the next level, which will most likely be support and resistance. These are what they're using to try to understand the markets. Now, these can be effective, but these can't be what determine your moves. It can't be whatsoever. And you can't base it off of support resistance because this is what the market makers are doing. So let's put this, let's move that. So this is what the market makers are doing. So you have your move. You have, the market coming up. The market coming up, it's coming down, and it's coming up. And let's say you're bullish. The market comes down to here. You're looking like, okay, Maybe it just previously broke out of this support level that was once resistance. And now it's so-called retesting the market. What most traders would do that are looking at that and trade based off of support resistance, they would open up a trade and they would put their stop loss below the support level because that's supposed to support their trade. It's supposed to be a safe area in the market for traders to get involved in. So a lot of people are looking for that trade in hopes of getting the market to go up and getting a good trade out of that. Something similar to that. Or to go all the way up, like most traders want the bigger moves. So your trade looks something like that. From a risk management standpoint, just off the numbers, it makes sense. It's a good trade. You're looking for a good reward. You're not giving up too much from a stop loss level, but it makes sense. Here's the problem. The banks can see where most traders are looking to participate in the market, but most importantly, they are looking for where liquidity is. Now, liquidity, the banks are doing huge numbers in trades, huge volumes. You think your standard lots or 10 standards or 100 standards are big. How about 100,000 if they don't even use the same metric, but let's say 100,000 standards or 1,000,000 standards in one singular trade. That's going to move the market. But the market, Forex market, is like a checkbook or an accounting sheet. And most importantly, it operates like a balance sheet. Now, for people who don't know accounting, which are most people, understand for the market makers, so these are large institutions, they need large amounts of liquidity to place their trade. So they need enough orders in the opposite direction. Move this over. They need enough orders in the opposite direction to enter the market. So if they are placing 1 million buys, needs 1 million sales present to execute. That's the biggest key when it comes to market makers, is that they need the liquidity to be in the market in order to take the other side and profit off of it. So knowing that as a trader, how does this affect your trades? Well, if a lot of traders are seeing this exact same move based on how most traders are educated, a lot of traders see the exact same move, then what's going to happen is there is going to be similar stop losses placed. So what the market makers will see, they'll see something like this. And they'll see liquidity in that level. So they'll see stop losses, all these clusters of stop losses from their buy trades because a lot of people are taking this buy trade. So they have stop losses all in here. And over time, the stop losses will accumulate because not only will traders place this buy to go up on the retest, they'll place it also when there's evidence that it is going up. And why is this important? Because a stop loss of a buy is a sell. Let's say the market makers want to make this buy as well. The stop loss of a buy is a sell. Well, what's the other side that's happening? Because it's not just retest traders. There's also momentum traders or breakout traders. And what are breakout traders thinking? Let's just say, click on this. Let's just say this doesn't exist right here. This move doesn't exist. We're still down here. Breakout traders are looking for the opposite move. So they're looking for it to break this support, and they're looking to take a trade like that. So that's a sell trade. And there's a lot of sell trades accumulating. So once again, you have more and more liquidity popping up because all these traders are making trades in similar fashion, whether it's a stop loss of a buy trade or a sell order of a sell trade. Those are both sells. So now what does the market maker need to do? Everybody's buying at this level. The sales haven't executed. So what they do is they'll try to induce more traders. So more people are buying. Second retest, okay. Some people wait for a second retest, so there's more people buying. Goes up again. Momentum traders going upwards are buying. So trend momentum traders are buying now. And then they do something like this. They place a sell to get into this area. So now these traders are stopped out. These traders are stopped out. These traders are now in the market for sales. And then after that happens, then a large move comes up. Big candle forms, and then successive momentum candles in that direction come up. That's how market makers play the markets and play the traders. And this happens in different variations. You could flip this upside down and this same exact scenario would happen at the top for a sell. They would buy into the market, capture a lot of traders, and then sell it back down. Here's what also happens when those big moves happen. You have an area, and let me try to depict it for you. The big candle happens, and you have something like this happen. You have a big candle, and then you have a sell candle here. I'm going to turn this back red. You have a sell candle here. And you have this candle. You have this candle come up. I'm oversimplifying it. Normally it's not just two candles. I'm oversimplifying it for a reason. So market makers come in, candles come up, and remember, the market is like a balance sheet. The market does not come back down initially to retest that momentum. So what happens here is you get something called an imbalance. And this is like a gap in the market. that over here. So it's like a gap in the market. This is another asset when it comes to market makers. So now you have all these buy orders open in the market. Market makers made the profits. They get out of the trade. You get this sell. You get this, not because them getting out of the trade means that they have to sell. So a red candle forms and it closes there. A lot of buying orders. So what tends to happen is they're not buying anymore. They're not buying anymore. They got their move. So sales start to take over the market. And a second thing's at play. They sold down here. So they sold here as well. They're losing this trade with this buy. So what they're looking to do is to let the sales play out, or they can play both sides and sell as well. Bring it back down to here. What happens when the market comes back down to here? They broke even on this losing trade. So now they got to close this trade out. What do they do to close the trade out? They buy. So now they're in a all net buy. The sell is over. They closed out. And now they're full profit with the sell. That's how they play in the market. This would be called a mitigation point. Some people call it an order block. This would be imbalance. So for people who are brand new to this, this may be a little bit harder to understand, harder to grasp, because this is not the normal way of trading that you may have been taught. But this is exactly what they're doing. And of course, I'm oversimplifying. There's more complex scenarios that happen. But this is a simplification of the framework. All right, let's look at a live example of how this market maker structure plays out. When you're looking at the charts, like I said before, you determine what the structure is. So you're looking at the charts, you see that there was a significant lower high that created a lower low, and then you had a lower high, but it did not create a lower low. It created a higher low. So now you're in flux. You're trying to see, okay, what's going to happen? Is it going to continue down or is it going to go up? In this case, it went up and it created an impulsive move. So for what we talked about earlier, you can tell that obviously there was an institutional play here because the candlesticks were sharp. They were decisive, meaning that they were bigger candles that went in one direction, didn't have a lot of pullback or large wicks in the opposite direction, and really defined a move. But also, what you take notice is not just the move, but the anatomy of that move. So you have a point in the market right here where there was not one, but two significant sells that failed to continue in the market, and then you had the buys up. Remember what I was saying about where traders are. So if we zoom in on this, so let me actually zoom in. Let's zoom in on this part right here. Just this part right here. So remember what I was talking about. Do a little bit of a zoom out. Remember what I was talking about when it came to where people are placing their buys, where people are placing their orders. You have two things going on. You have the market And let me actually take a step back. You have the market. You know how most people trade, support and resistance. So people are outlining this area as their support, then became resistance. It gave the retail traders, a nice retest and continuation. You know, the normal price action trade that a lot of retail traders make. So they were rewarded on that trade. So what happens when the market returns to that level? People now think that this is a point to trade. So they try to trade down into the markets. So here's what happens. This is what that position looks like. They're trying to recapture the same move, if not more, on the second time, on the retest. And then stop losses probably above here. So this is their ideal trade. So this is what market makers have to do. A lot of people are selling here. They want to have a buy, but they want to buy it at a lower point. So what do? They come down into this imbalance that was created here. This imbalance created right there. So let me change it so that way we don't get confused. Let's actually leave that as imbalance and make this price level. So there we go. Support become resistance. People are trading down. There's imbalance down here. So people are coming into this zone. There's a lot of buys here. They want to balance that out. But here's what's also happening. People on a smaller time frame are looking at this. Let's go down to 15 minutes. Bring it back to that point. People are looking at this right here, those same break and retest traders, as a point in consolidation. And looking at this right here. So remember, the market makers, they want to see people look to sell. So a lot of people, and with the momentum traders, they're looking for the market to dip back down. So people are selling, momentum traders are selling, they're selling into it. They see this point of the zone here. They have sell stops. Pretty sure there's traders making sell stops right in here if they're not paying attention to that zone. Or if they're paying attention to that zone, they want them to get past the price, to get past the upper part of the zone to continue to sell down. So you have imbalance, creating the sales. You have momentum traders. You have sell stop breakout traders. And you also have people who bought here, seeing the reversal, looking at this as a stop profit. So you have multiple traders, and a stop profit of a buy is a sell. So you have multiple traders giving out liquidity or indicating liquidity in a certain zone. Indicating liquidity. So you have that happening over and over again. Not only is that happening there, they're accumulating that liquidity there. They're also creating micro mitigations to get into that liquidity and create a consolidation of range. They sold into that here. to create this move. Market then creates another range in here. Why is that important? Because, once again, if you have people trading the buy, putting their stop losses in here, so you have more liquidity in this area. Also, you have the order block being formed let's do here. You have the order block from what they sold into also right here. So you have liquidity, people selling, people taking profit, stop losses, stop profits, all happening in this area. And then you get this dip right into that area, and it doesn't go below it. And it just shoots up from there. That's just a smaller move. If we zoom back out, go back to the 1 hour. Go back to the 1 hour here. And you see price shoots up from that point on because you had all this play out on a smaller time frame. They use that liquidity and also jump up from there. This was an example of a mitigation plus liquidity zones that created that point. There's multiple scenarios we can go over, but just understand the anatomy of it. Once you find an area where liquidity could be happening from a retail side or a institutional mitigation side, if you can get those two to be in the same spot, that's a very high reaction zone of a price level where you can look to make your trades and catch the smart money in the direction that they're trying to go.